Great. So, what I've been asked to do today is to address the gathering about my thoughts on the future of banking, which I guess the world over, at least outside of India, looks very bleak. But what I wanted to try and persuade you today is that the future of banking in India is really quite interesting and exciting, and is set to see over the next few years a very, very fundamental change and shift of gear. So let me start with briefly with a quick perspective on the historical evolution of banking in this country. I think like most other things in our country, economic, we've been through several decades, at least until the 1990s, of flirtation, not just flirtation, but a significant commitment to a very directed way of conducting economic policy. So that culminated in the nationalization of the banking system. And the nationalization of the banking system, when it was executed, was with really a view to delivering inclusion of access. I think for the longest time, it's been a legitimate concern that private banks generally are not inclined to deliver or invest in last mile connectivity and service to the bulk of the customer base, which in our case, in a country like India, happened to be very, very poor. So the nationalization of the banking system became a complement to the thrust on Garibi Hatao, the Green Revolution, and such like. And the banks then became an important conduit for directing credit flow. So the whole priority sector lending business became an essential component of the nationalized banking system. So the banks were then complemented with traditional development finance institutions. So of the likes of IDBI and ICICI, NABARD, these entities were created, they were nurtured to deliver long-term financing. The view being again that private banks and banks in general have great difficulty for commercial reasons doing long-term financing. And as a country, we really needed to develop the asset base for an industrial foundation. And therefore, we needed some kind of state entity, really, to help provide the long-term capital and finance the creation of these assets. So you had a banking system which was taking care of working capital needs, short-term financing of the customer landscape, with an overlay of directed credit, which made sure that this credit was allocated to less of segments of the customer base that had poorer access. And this was complemented then with development finance institutions that were there to provide long-term financing. So this was the architecture that survived for many years, for several decades, and arguably served the country at that time quite well. So the massive expansion of branch network that took place in the banking system was really partly the result of nationalization. I think public sector banks were felt obligated to expand the branch infrastructure. And that dramatically improved access of customers, although, you know, the glass is always half full. A lot of people still argue that access to banking is a challenge. But point I'm making is that PSU banks, led partly by design of policy, the rapid expansion of branch infrastructure, particularly in rural India. Then came the crisis. And with the crisis, a lot of these systems came under the scanner. So if you go back to the 1990s, there was a growing consensus worldwide that development finance institutions were not very effective from a governance point of view. They contributed more to the misallocation of resources rather than to the intelligent allocation of resources. Privatization was very much in vogue in all of that. So starting with the 1991 reforms, all this architecture started being dismantled. And during that period, we also saw a very rapid growth, if you recall, of non-bank finance companies. And what that was in some way indicating is that despite this massive nationalization program, almost the forced expansion of branch capacity, et cetera, despite all our development finance institutions, there were huge unmet credit needs in different parts of the economy that were served by very vibrant and rapidly growing non-bank finance companies. We then had the Asian crisis, which was an external event. In parallel, consequent to our reform program, we started dismantling all our trade barriers. The dismantling of the trade barriers led to a very dramatic increase in competition across the customer landscape. We also saw delicensing, industrial delicensing, the net result or outcome of which was rapid increase in competition. And therefore, a lot of the companies that were significant borrowers from the financial system found themselves in a situation of rising stress. And that led to a very rapid deterioration in asset quality of the banking system. And asset quality of also the development finance institutions. So ICICI, IDBI, they saw asset quality deteriorate very dramatically at that point, and a lot of NBFCs were also going out of business. And NBFCs were actually funding themselves through, not through deposits, but selling all kind of paper to mass affluent or mass affluent community of investors who were buying, lending effectively to NBFCs. And when NBFCs started going down, a lot of people lost money. So there's a confluence of things. External competition from internally and externally because of the dismantling of the licensing regime and dismantling of the trade regime. There was the Asian financial crisis, and there was stress on non-banking financial institutions. These three things came together to change regulatory perspective dramatically, and very quickly we abandoned the idea of development finance institutions we said, okay, we will dismantle these entities, help them convert into banks, and the future of banking, now this is late 1990s, early 2000 in India, would be universal banking. Regulation of NBFCs became much stricter. The RBI decided at that time to become much more difficult about registering new NBFCs. And so the whole regulatory perspective became much more bank-centric again. That's point number one. Point number two is that with this whole fashion of privatization and private participation, a number of private banks were allowed to take hold. So you had the first wave of private banks that was spawned at that time, starting with IDFC Bank and so on and so forth. Until then, the old private sector banks, as they were called, were treated as second-class citizens, and even today, actually, they would complain that in regulatory context, they're treated as second-class citizens, but at least they were given more space to grow, which they started doing. So private participation in banking, the death and demise of development finance institutions, much tighter regulation on non-bank financial institutions, the core regulatory focus becoming universal banking with increasing privatization was the new paradigm that emerged in the first years of the 21st century. Now, since IDFC Bank was spawned, which was about 1994, so it's about 30 years, no, 20 years. What has happened? It is remarkably static. I mean, it's a very, very slow change. If I show you the, So just between 2000 and 2014, the share of public sector banks in total bank lending has come down at the rate of 1% a year. So, we are now we were at 80-some% in 2000, and we're now down to something like 73%. So relatively slow decline in public sector banking share. It's remarkable how, despite a whole number of new banks, private banks coming, resilient the share or market share and footprint of public sector banks has been. Right? So that's one thing that we note. Second thing that has happened since this paradigm shift that I was talking about over the last 15 years now is that we've had the infrastructure boom and then the bust. So what has that done? You're all familiar with what that has done to the balance sheets of banks, particularly public sector banks. And so today you have a situation where public sector banks still account for almost 3/4 of total bank lending, but have very fragile balance sheets. They are in dire need of additional capital. The requirements for additional capital, you've all read the reports, range from anywhere from 1.5 lakh crores to 3 lakh crores. But even if we take roughly 2 lakh crores as the amount of capital they need to plug the hole on account of impaired assets, and we won't even talk about the capital they need for meeting the new requirements from Basel III, we are talking about having to treble almost their market cap if they are to raise capital without government falling to below 51%. So now we have a real, crisis, if you like. I'm characterizing it as a crisis. It's not really a crisis, but it's a serious challenge at hand, which is that almost 3/4 of the banking system requires so much capital that it will, and government doesn't have that capital, that it will necessarily, if we have to raise that capital, either the government will have to cough up, which they don't show any signs of doing, or government will have to let go of the ideological anchor of public sector banks, nationalization of banks that was seeded way back in the 1970s. So we are coming to a real point of resolution or crisis in that sense, that government's perception, perspective on keep maintaining public sector banks and their ownership in them is going to be very hard to hang on to in view of the capital recapitalization requirements of these public sector banks. So that's the starting point of today's situation. To summarize in just one sentence, 3/4 of the banking system is starved of capital. Their principal shareholder doesn't have that capital and is ideologically caught in the headlights, in its own ideological headlights, about letting go or wanting to let go of its majority ownership in the banks. Because of the political legacy involved that lies behind the notion of public sector or government ownership of these banks, I believe that this conundrum will not be very easy to resolve. And therefore, it is almost certain that 3/4 of the banking system or thereabouts, even if some banks get access to capital, at least 50% of the banking system, public sector, will be starved for capital over the next 5 years. So that's I think, sets the stage for now painting the picture for the future of Indian banking today. Second stylized fact about banking reality today is that over the last 15 years, and especially over the last 5 years, we have seen cascading evidence of very rapidly changing customer behavior. And just to give you an indication of that, I don't know how many of you, I think most people are aware that we have close to 1 billion cell phones in the country. But not many people, or not as many people, may be aware that we have 150 million smartphones now in the country. And the average cost of the low-end smartphone over the last 5 years has declined from 15,000 rupees to under 2,000 rupees. And projections are that the population of smartphone users is going to double within 18 months. Even if it doesn't double, within the next 2 years, you can imagine, or you can expect, that there will be about 250 million, at least, smartphone users in this country. So that's one piece of evidence about changing customer behavior. Now, these are not necessarily customers of banks, but all these smartphone users are very rapidly getting onto e-commerce. And they are going to be settling their transactions, e-commerce transactions, increasingly on the smartphone. Now that begins to engender or trigger a change of behavior vis-a-vis their banks. So this is a very, very important change in the making. The second big change that is happening, and it's accelerating, is that the importance of the bank branch is declining. So there's one research report which is in the public domain, which shows that for HDFC Bank, for example, non-bank branch revenues now account for 25% of business, right? And this has been a steady increase over the last 15 years. But one of the consultants have shared some data which is really quite dramatic. Just in the last 12 months, footfalls and associated revenues and business in the average branch in some survey that BCG conducted, in 12 months has fallen 7%. That's how fast customer behavior is changing. So this is whatever little hard evidence I could find for it. Smartphone use, revenues, and usage of bank branches, right? But anecdotally, you all know, or you don't know anybody that still goes to a bank branch. Very few people actually go to bank branches anymore. And it's really small businesses that tend to use bank branches a lot. And they send peons to do bulk cash settlement and stuff like that. So there's still some bank draft business that happens in a branch. Some people will go for check clearing and so on. But those numbers are declining very, very fast. And this is certainly happening in the top 50 centers in the country. But given how fast, things catch on now, I wouldn't be surprised if this trend also accelerates in Tier 2 and Tier 3 India in the coming months, not even years, right? As against this, I don't know if we have this I've talked about. There's another data point. Mobile banking customers increased from 5.9 million to 35 million in 3 years. And this 35 million, I can guarantee, will be close to 50, 60 million by the time we're done with this financial year. Okay. While all this is happening, take a look at what's happening in branch structure around the country. Notwithstanding all these signs of very rapid change, banks continue to invest in their branch infrastructure. And in fact, what is ironic, if you look at the slope of these changes, since 2013, actually, branch growth has accelerated. Right? So that brings me to my second factoid, for why we are in for very fundamental and dramatic change. So first point was, just to repeat it, public sector banks have troubled balance sheets. They won't be recapitalized very easily. So that's point number one. Point number two is, notwithstanding increasing evidence of very rapidly changing customer behavior, mobile phone penetration, non-branch activity, etc., banks have continued to invest in branch infrastructure. So now what does this mean? For me, it means one very clear thing, that if over the last 15 years, the share of public sector banks in total lending has been coming down at only 1% a year, I think that over the next 5 years, their market share is going to come down much faster. This is all speculation, but if I had to guess, I think within 7 years, 5 to 7 years, the market share of public sector banks from 73% will come down to under 50%. That's how fast it could change. And it doesn't require rocket science to do it. If you just do the back of the envelope numbers, and you can see it in the analyst report quarter on quarter. Right? So if you heard Arundhati Bhattacharya and her projections and guidance for next year, she's saying SBI, which is 25% of the system, will grow at about 12%, I think she said. maybe 14% is what she's expecting over the next 12 months. But when you talk to Aditya Puri or you talk to, Indosin, you talk to all these guys, they will tell you their balance sheets are growing at 25%. So if private banks continue to grow their balance sheets at 25, and now you have some upstart bank like IDFC Bank with a much smaller balance sheet, so why can't we grow at 30%? So what I'm saying is that the average private sector banks can grow at 25, 30%. And public sector banks will struggle to grow at 12%. If you just do the math on that, project that, and the overall system, by the way, with a 6% GDP growth, forget about 7, 8, to pata nahi, whether we'll get it or not, but let's assume 6%. So that's that'll generate at least a 12%, say, nominal growth in the overall system for financial services. It's not an unreasonable assumption. Historically, that number has been 15% a year. We've seen growth in deposits and loans, et cetera, through bad times and good times. Average growth of the financial system in India has been about 15%. I'm saying forget about that. Let's just take an average of 12%. And you have public sector banks growing a little less than that average. Private sector banks growing significantly higher than that average. Within 5 years, 7 years, you'll see public sector banks' share come down to 50%. That's a huge structural change in the system that we are witnessing. So when people say, well, what has this government done? Where is the change? Where is the reform? This is staring us in the face. It may not be done deliberately. You could argue that the government is deliberately starving public sector banks of capital. And there are some signs that that is precisely what they've been doing. So whatever 70,000 crores they've announced, I don't think they will give it evenly to every public sector banks. So I don't know exactly how this will resolve itself, but one thing is clear, their market share is set to decline at a very dramatic pace. So that's the first prognostication I offer for you to consider about the future of Indian banking. Now, there are 3 other things that are happening, and they have their own set of consequences. Now, what are these 3 things? The first is that the payments infrastructure, the plumbing of our financial system, is expanding and becoming sophisticated at an exponential rate. Now, what is the plumbing of the financial system? The plumbing of the financial system is really the payments and settlements infrastructure. So if you think about the payments and settlements infrastructure of the financial system, we've had interbank settlement, so we've had RTGS for a long time, and so on. But we haven't had, and then we have the ATM system that allows interbank settlement, from one person to another. So I'm withdrawing cash from somewhere. I can withdraw it from any bank, from any ATM. So that requires a plumbing that will enable one bank to settle with another, no matter in which bank I have my deposit account, right? So that infrastructure has already been there. We've had settlements for credit cards, which has been the traditional settlement, piping that has been created by Visa and MasterCard. So they have landed up in this country like they have anywhere else, and they said, okay, we will settle credit transactions or debit card transactions, but you will have to clear through us. As a result of which, the universe or the ecosystem of merchants is actually quite small. I don't remember the number off the top of my head, but compared to the size of our country, the ecosystem of merchants involved in, the Visa, MasterCard, credit card network is really very small. It hasn't grown all that dramatically in all these years. Now comes 2 major developments. One is the creation of NPCI, National Payments, what does it stand for? Corporation of India. We are so used to thinking in acronyms that we forget what they stand for. Soon I'll forget what IDFC stands for. But NPCI is a major landmark development, right? So what have NPCI done? NPCI have now very dramatically expanded this plumbing that is going to revolutionize the way person to person or merchant to merchant or business to consumer transactions are going to be settled. And these, because of the new infrastructure that they're creating, these pipes will connect not just necessarily through bank accounts, but they will connect people who want to settle transactions with each other through the telecom network. So NPCI, in a nutshell, has accelerated the convergence of the telecom network with the banking system and the payments infrastructure in the country. In the next 3 months, they are going to come up with an interoperable settlement system that if I am a wallet user in Airtel, I can pay you electronically. If you have a wallet on a Vodafone network. So up till now, these were closed circuits. So if I had to settle wallet from my wallet to your wallet, we could only do it if we are both Airtel users. In 3 months, that will change. I will be able to pay anybody with any wallet with any telecom company. That's one major development. I mean, so NPCI, and it's got a multitude of products, but which is revolutionizing the payments infrastructure. Second big fundamental development, as you are all aware, is Aadhaar. And Aadhaar is the unique identification system, which facilitates now KYC authentication, a know your client or know your customer authentication, which is critical from a security point of view, from the regulator's point of view, from RBI's point of view, in order to originate any kind of financial transaction. So that's become much simpler and much cheaper to do using Aadhaar authentication. So I don't know how many of you saw one of our stalls outside. We've tried to replicate a little Kirana store, which has a micro ATM, which uses the Aadhaar technology basically to authenticate you and to deliver cash to you from your bank account, which need not be with IDFC Bank, could be with any bank. That's what the combination of Aadhaar and the NPCI infrastructure has done. Third development has been this government's focus on expanding the number of bank accounts. So, this Jan Dhan Yojana business. So, Jan Dhan Yojana, under that scheme, mainly public sector banks have done this. 70% of the Jan Dhan Yojana bank accounts have been opened by public sector banks, or maybe even more. We now have 192 million new bank accounts that have been created. 192 million. And I'm told, or it's on their website, that I'm forgetting how many of them are active. 68% are active. So there was a fear at one time that very few would be active, but now almost 2/3 or more than 2/3 of them are active. And it's a very large number of accounts, but the savings that they have now generated in these active accounts is close to 27,000 crores. So per account, it's a very small number, but the point is that the reach, this is real access now, that is being delivered to the average Indian citizen. So this is what some people have characterized as the jam trinity, right? So you have the Jan Dhan Yojana, you have Aadhaar, and you have the mobile phone coming together. These three things, the confluence of these three things, is increasing access to financial transactions in a very, very fundamental way. So that's one thing that has happened. The second thing that has happened is that you have now, whether it's one or two. So payments infrastructure development, NPCI, I had on my list as one important development. Second is the confluence and government's emphasis on Jan Dhan Yojana. So that's the second thing. The third thing that has happened, which is initiated by policy, is the issuance of new bank licenses. So we are obviously the beneficiary of that process. 2 universal bank licenses in the last couple of years, Bandhan and ourselves, but a whole bunch of payments bank licenses and small finance bank licenses. Now, what is this going to do? On top of the investments that NPCI made and on top of what the JAM Trinity is doing, now you have a whole bunch of new banks that have come up. And if you look at the payments banks themselves, it's a very unique, interesting concept. So payments banks are not allowed to lend. They're allowed to aggregate deposits, however, up to, they're capped at 1 lakh per deposit, right? But they're allowed to capture all the transactional flows from the customer community. So remittances, all kinds of payments, settlements, they will do. Who have gotten these licenses? If you look at the list of people who have received the payments bank licenses, a very large number of them are telecos or e-commerce companies, right? Telcos have a very large customer base. So do e-commerce companies. The e-commerce companies have the additional advantage that they are funded by people who don't need to make money. So at valuations that are very fancy. So they've raised a lot of money, right? The telcos are extremely well capitalized. What is going to happen is that there is going to be a race to the bottom now to aggregate customers. So when you combine these three things, the second critical feature of the future of Indian banking is this. That again, over the next 5 years, where the share of public sector banks in total lending is going to come down from 73 to 50, my projection, right? Second thing that's going to happen is that within the next 5 years, you will see a dramatic build out of the last mile infrastructure to improve access to individuals to financial services. So consumer convenience as far as financial transacting is concerned will improve dramatically. So people will not have to rely on ATMs anymore. There will be all kinds of virtual ATMs of the type on display outside, micro ATM. There will be transactions that will be happening electronically. So there are different people who expect this to happen at different rates, but the importance of cash in the Indian economy is going to start declining. So now what does this all mean? Now you put these two things together. Let's try and understand what it means for existing banks, right? So it means at least two things for existing banks. One is that there will be greater competition for their depository franchise. And the second thing that will happen is that there will be greater competition for the revenue pools that were related to financial transactions. So all the remittance flow, for example, all the money that people were making on bank drafts, check clearing, and so on, those revenue pools will be under some pressure. So increased competition for existing banks is a given. So public sector banks are, really in trouble, if you ask me. Not only are they facing competition from the existing private banks because of their constraint on capital, now they have to deal with a whole bunch of new players who are going to be cutting into their revenue pools of different kinds and their depository franchise. For existing private sector banks, for the HDFCs, and ICICIs and Axis's, IndusInds of this world, they will also be subject to greater competition on certain revenue pools and for deposits, right? So one view to take is this, God, this is terrible. It's going to be such vile competition. It's great for the customer, it's great for the consumer, but isn't this going to drive down the profitability of existing banks? So I think my answer to that is, it depends. And let me explain why I think it depends. I think most of you will be aware that financial savings, how am I doing for time? 10 minutes, okay. Yeah, I think I should be more than enough. Most of you will be aware that financial, okay, let me step back. Total savings in our country are down from a peak of about 34% a year. In 2000, whenever it was, 11, we're down to 30%, right? Household savings, which were at the peak around 21, 22% of GDP, are now down to 17, 18%. So you've seen a significant reduction in household savings. Although internationally, our household savings are quite high. Most Western countries have lower household savings. Even in China, actually, household savings are not much higher. China's savings rate is much higher than ours, only because of corporate savings. That's a separate issue, let's leave that aside. Focus on household savings in India. They've come down from 22% to 17, 18%. But financial savings of the households has remained stable at about 8%, 7.8% or so of GDP. I think it's about 7%. So financial savings as a share of total household savings has been quite small. Ironically, the share of financial savings in total savings has gone up, household savings. But that's only because non-financial household savings have come down quite a lot over the last 4 or 5 years. And I don't think anybody really understands why that has been happening. I was also a little surprised when I looked at the data, because my impression was that household financial savings have shrunk. But actually, that's not the case. Household financial savings as a share of GDP have remained fairly stable at between 7 to 8%, but non-financial savings have shrunk 100 basis points as a share of GDP. My hypothesis is this, that with the small finance banks and the payments banks taking root in this country, there is a real prospect for the first time that the pool of financial savings, household savings, will actually increase. So the share of total household savings, which was 17 down to 18%, the share of that is financial will, I'm expecting, grow because of the participation of these new banks. Because they will deliver access and convenience in a way that has never been done in this country. In our own, deliberations and so on, when we were preparing for IDFC Bank, when we got feedback from, especially rural customers, they're surrounded by bank branches, but they don't use them. They don't use them because the quality of service they get is absolutely awful. They feel intimidated. They just don't want to use the branches. Now with technology and payments banks and all these kinds of things, their willingness to use formal financial services will increase, and therefore the pool of financial savings will actually increase. And therefore, the competitive pressure at first blush that one sees, there'll be a huge competition for depository franchises between existing banks, mara-mari hogi. I don't think that is necessarily the case. Why? Because the size of the market itself is going to expand. So it's not as if there is just this much savings and new banks are all going to be fighting for that same pie. The pie itself is going to grow because of deeper penetration. That's my hypothesis. Second thing that is likely to happen is that as the deposits in the payments banks increase over time, right? Remember, payments banks cannot lend. So what do they do on the asset side of the balance sheet? All they are allowed to do is to buy government paper. Okay? So if you buy my hypothesis and you say that payments banks are actually developing a depository franchise by expanding the size of financial savings in the country, these financial savings are now being intermediated into what? Into government paper. Therefore, the need to maintain the same level of SLR, that need will come down. And so my third prediction is that SLRs in the next 5 years are going to come down. That will give greater flexibility to the existing banks about what they do with their assets. So I've made 3 predictions so far. Just to summarize before I conclude, public sector bank share in total coming down dramatically. I'm saying rhetorically 50%, right? Second, that the pool of financial savings is actually going to widen, right? And third, that the public infrastructure, or the infrastructure, the last mile infrastructure for financial access is going to improve dramatically. The fourth prediction I'm going to make is this, and you're already seeing the signs of that develop all around us. Every second day, somebody comes up with another SME-focused NBFC idea, right? And what are they selling? They're saying, okay, I'm going to do data analytics, and I'm going to make SME and MSME lending into a science now. Now, over the last 10 years, a lot of these people have come and we've dismissed them. This is not possible, it's very difficult to do, etc., etc. But my prediction is in the next 5 years, this is going to take off. Because access to data is improving dramatically. The quality of data is improving dramatically. So you can scrape data from whatever you're doing on your mobile phone. If you can scrape information from how you're dealing with your e-commerce company. This is on top of the credit bureaus that have grown dramatically, the data sitting there. Empirical information about customer behavior, therefore, is becoming more accessible. On the basis of that, it will realistically be possible to develop predictive algorithms that will allow you to underwrite credit much faster, and more importantly, to a customer segment in the economy that has hitherto been under-penetrated, which is below the SMEs, the MSME segment. This is real financial depth. Now, who are these people? Chit funds. I mean, the chit fund industry in this country is humongously large. These are people who fund their working capital requirements by borrowing from each other. These are closed groups of savers that come together. It's a rotating kitty. Everybody pools their savings. Every month, one member bids for the chit, as they call it. It's a market clearing rate. And whoever bids the highest, subject to a state-wise regulatory cap, they get the pool that is available in the fund. These people do not rely on existing banks. This is how a lot of people are funding themselves. Then there is a money lender, etc., etc. So a lot of the small businesses, and this is the mirror image of our job market, by the way. Did you know that our job market, our employment force, people of employment in the workforce, has grown from about 380 million to 500 million in the last 20 years. And in those last 20 years, the size of our organized labor force has increased from only 26 million to 30 million. And within the organized labor force, this is just a little tidbit, nothing to do with my main argument, the size of government employees has been relatively stable over the last 20 years at 19 million. Right? So 94% of our labor force is all this bunch of self-employed people, the bulk of whom don't have access to formal credit of any kind. If we had data on these people, you could actually expand the addressable market for loans. So that's my fourth prediction, that as the market for financial savings will grow, the size of financial savings will grow because of greater penetration and depth and reach, so will the market for loans. And for the first time, there will surely be crises, because there will be a bubble and then it will burst and there will be all kinds of learning in that process. But for the first time in history of our financial markets, there will be a new class of customer that is not large corporate, that is not mid-corporate, that is not traditional SME, but that is a self-employed smaller guy who will get access to formal credit. So that's the future of banking. Those are my four predictions. So now what does this mean for a new bank and for existing banks, like IDFC and all of that? For us, we have the opportunity to bet behind this change. For IDFC Bank, I think the story in a nutshell is that we have a running business that is a very solid franchise, which has been very narrow until now, just doing term lending to infrastructure players. We have the opportunity to diversify that footprint immediately, not only to non-infra players, but to our existing client base, to offer them diversified products. And I don't see a great challenge in doing that over time because of my first projection. So public sector banks are going to have difficulty. So even in that bit of the overall asset pie in the country, which is large and medium corporates, we see IDFC Bank taking market share and growing our business. Okay? So that's the first thing that we will do. Second is learn from all these changes in the infrastructure, in the payments infrastructure, and bet behind changing customer behavior, as we've talked about, to get our share of customers in the top 50 centers around the country, where despite all the mounting evidence of rapidly changing customer behavior, banks have continued happily to grow their number of branches. So we think, Moss, we need to think differently about this. Of course you need branches. But branches are increasingly going to become an investment, a marketing investment. to show that we are here. Nobody's really going to use the damn thing. So you want to architect your branches accordingly. You don't want branches as a place of doing a lot of business. It's just a presence marker. Physically, we are here, right? And then the rest will have to be done through other forms of connecting with customers, whether it's through the mobile phone, or it's through the mobile phone, or it's through the mobile phone. Basically, the world is going to move to a smartphone. And that is where we aim to, we have to attack. We don't know how successful we'll be, but we know that is what we have to do. And that's in the top 50 centers of the country, where, by the way, 70% of all our savings come from those top 50 centers. So that's our second axis of attack. And the third is what rhetorically, internally, we call Bharat Banking. And that's really the name of the game strategic for IDFC Bank, is to take advantage of all these trends, both in the payments infrastructure, the Aadhaar sort of facilitation and all of that, and data-based analytics on the asset side, to get our share of the expansion in financial savings, do our bit to expand financial savings in the country, and to do our bit to reach into a whole new customer segment using data of different kinds. So there are lots of technical problems to solve on that. You can certainly reach a customer using data, but if that customer fails to pay, how do you collect it? There's not a trivial problem to solve, but this problem will be solved. And that's the next generation of problem that a new age bank will have to address. So new customer segments, both on the assets and liability side in Bharat Banking. Our share of market in the top 50 centers where customer behavior is changing very rapidly, and we aim to connect with that changing customer behavior, and increasing market share in the corporate landscape at the expense we expect mostly of public sector banks. So that's my 2 cents on the future of banking and the future of IDFC Bank. I'm happy to take, we have a few minutes, so we can take a few questions. Let's open up the floor to Q&A.
Yes, so we'll have, I have some questions for Rajiv, but I would like you to have a first go at it.
Excellent. No questions. Yeah, there's one here.
Thanks, Rajiv, for that wonderful presentation. I just have a question that...
Sorry, yeah, could you introduce yourself?
Thank you for that presentation. I just have a question that it looks like that the unbanked piece of the population seems to be a huge growth driver going forward. But you also mentioned that this unbanked population is getting increasingly covered by the PSU banks because of the Jan Dhan Yojana and Aadhaar and all of that. Almost 200 million bank accounts have got opened under that. So don't you think that's a bit contradictory in terms of the opportunity for new players? Don't you believe that the public sector banks will still be very dominant in this new share of the opportunity of the unbanked population because of Aadhaar, Jan Dhan, use of technology, etc.?
So short answer is no, because the public sector banks have only opened these bank accounts because they have been directed to do so. I don't think any of them have really thought about it as a very serious business opportunity. By the time they get around to it, there might be a couple that actually get there. But I think that gives us fertile ground to develop a niche in that market before people recognize what opportunity it is. So I'm not particularly worried about that.
The second is that the private sector banks which have got set up over the last 10, 20 years clearly have become formidable. They also understand the opportunity and also have access to technology. So what is it going to be different for IDFC to be able to compete with these same set of banks who've become large, are efficient, and are willing to embrace technology to get a larger share of this emerging pie?
So I don't agree with you that they're efficient. I think Indian banks are hugely inefficient. They haven't seen competition yet. And if you already have a 70,000 strong, workforce, and you have 3,000-4,000 branches, for you now to redirect the ship for this future is not an easy task. So these people will have to be in cost-cutting mode very shortly. When the Reliance Geos of this world start hitting the marketplace, and the Paytms of this world start throwing money at last-mile infrastructure, people will have to worry about how they manage their costs. There has been very little or not enough. There has been insufficient focus on driving cost of operations down. Like all customer-facing businesses in this country, this is banking's turn now, where those who are able to deliver service at scale at the lowest cost, they are the people who are going to win.
Thanks. Thank you so much.
Yeah. This gentleman here. Yeah, sorry, you have the mic, please.
In terms of the growth of IDFC, do you see a role or potential role of actually acquisitions, particularly in the public sector area?
No. If we could buy assets or we could buy customers, we'll do it. But acquiring a going concern, especially a public sector going concern, is culturally very, very difficult. And I suspect that it will be just too much hard work and distracting for us. It might be easier to grow organically or to find other ways of acquiring customers.
So may I extend the question then, if the public sector banks come down to 50% market share, do you see the scope for significant mergers within the PSUs? Or what? I mean, it's a huge national problem, let alone a banking issue. So what do you see the solution to that, given the government's constrained in funding?
It's very difficult to predict that. I think that you will have I shouldn't be quoted on this, but you will have a few walking dead for quite some time. Eventually, there might be some consolidation within public sector banks themselves. I think that's probably the most likely scenario. So you will have within the public sector universe of banks, some banks there'll be 4 or 5 banks that will break away. The rest will continue to stagnate. They will be propped up for as long as the politics requires them to be propped up. And eventually, they'll be either folded in or most likely folded into the large guys. That would be my guess.
So, I'm Ajay Agarwal from Greater Pacific. What would be your view and take on the margins picture going forward? Because you have the IT guys who are prone to having a lot of money and not interested in margins or even trying to burn cash. And they would be there in the payment banks. You have the old CASA players who are getting it very cheap and lending it high. So how do you predict the margins in real, basis points where going forward?
So it'll be the same phenomenon. I'm talking about the next 10, 15 years. I suspect banks will see our version of what happened in telecoms. So it'll be about lower margins and higher scale is most likely how it's going to play out. See, so much of banking is sensitive to regulations, right? Unless the regulator allows specialized banks of some kind, like a custody bank, or I don't know, you could think of 2, 3 different types of banks, bank licenses that, might conceivably be introduced in the future. If everybody is basically going to get a universal banking license, small finance banks eventually are going to either merge into or themselves become universal banks. What I'm projecting is the most likely outcome.
So you're trying to say that there's a lot of room for some niche banks which are there maybe in particular spots where they can make more sense?
There could be, but I don't know if the regulator is going to get there.
Thank you.
The gentleman in the shirt here.
This is Andre Purushottam from Cogito Advisors. My question was really related to the what you see as the profitability of serving the bottom of the pyramid, right? Both in urban and rural areas. Now, various people are saying that there's a lot of saving potential there, but the cost of accessing these people could be high. And of course, there are enabling technologies like mobile applications that you referred to, etc., which could bring down this cost of operation. At the same time, you mentioned, for example, that people are going on this branch opening spree, which doesn't seem logical in terms of, Now, from your experience, if you were to, let's say, postulate in the future what would happen, how do you think there will be a significant loss-making phase, and after which the industry will start making profits on this incremental opportunity for the bottom of the pyramid? Or do you think how do you see it panning it out? How do you see all these factors playing out in terms of the opportunity, the enabling force of technology, and the increasing realization on part of the banks that their existing strategies are not well equipped to access that opportunity?
See, my sense is that you will not, at least for the foreseeable future, be able to make money from these new customer segments, let's say the lower income customer segments in the economy, if you just relied on their depository franchise. Right? So if you imagine, I've been trying to get data on this, it's been very hard, but I think this hypothesis is most likely correct. If you were to divide the country or households into, or the economy into, so the corporate sector, government, corporate and households, and you looked at households as rural and urban, broadly speaking, right? What you'll find is that, so if you just take the three segments, government, corporate and household sector is a net lender to everybody else. Corporates are net borrowers and government is net borrower, right? That's the flow of funds. If you split the household sector into urban and rural, you will find that urban households, actually, so it becomes even more concentrated. It's not a very large number of households that are net lenders to everybody else. So rural households are net borrowers in a macro sense, and it's urban households that are lending to everybody else. So they're lending to rural households who are net borrowers, corporates who are net borrowers, and government that's a net borrower, right? So any business that is focused just on rural, that focuses only on the liabilities piece, is not going to make money. At least for the foreseeable, notwithstanding technology and all of that, right? And you can see it in the Jan Dhan numbers, right? You have 192 million accounts, but you only have 26,000 crores in savings. Even if that goes up, it trebles or whatever, the reality is that these households don't have that amount of net saving, right? So what's most likely going to happen, and what's the current mindset, is that most bankers are not comfortable lending to this segment of the economy. And therefore, dealing with this segment of the economy is loss-making. So it's only those who are brave enough to lend. And my prognostication is that with data becoming available, there will be more and more people who will venture in that direction. And it will start with NBFCs, specialized NBFCs that will show the way. When they start showing, well, this is good performance, actually, like MFIs have already shown that lending to the poor through JLG is not a bad business, actually. A whole new generation of SME-focused NBFCs are going to show the same thing. As banks look at that data, become more confident, some of them will venture into this rural segment of the economy and start lending. That's when it becomes profitable for them. So my point, wearing my IDFC Bank hat now, is that if we are willing to take the bet that actually lending to this customer base is a good business, then we'll be early in opening up this market.
Now, I just wanted to share an anecdote with you in terms of, if you look at any state bank branch, which is, let's say, in the less affluent areas, you will find a whole stream of customers just queuing up to deposit money, right?
Sorry?
You'll see a whole set of customers just queuing up for about half an hour, 45 minutes just to deposit money into the account.
Right.
Which means there are savings.
Yes.
But what is inhibiting this fact is the fact that there's such inefficiency there that the auto rickshaw driver feels that I don't want to sacrifice 1 hour of my amdani in order to just do this deposit business. So if there was a paradigm shift in terms of making it more convenient for them to deposit the savings.
So this is the point I was making about financial savings expanding.
Right.
Financial savings will also expand as it becomes more convenient for people to deal with banks.
Right. So
payments banks or small finance banks.
So is it possible that if you change the paradigm with which this entire process is collected, that the path to profitability could be actually faster than what we are anticipating?
It could be, and you might see that in the small finance banks. So, there are 2 points here, right? In an overall macro sense, this customer base is savings short. That doesn't mean that there are not more savings that can come into the system because for convenience reasons and all that, right? But in an overall macro sense, they are savings. They're net borrowers, they're not net lenders. Small finance banks who are really dealing with that customer segment, they are actually betting that they will be able to mobilize significant amount of deposits from this customer base. And there is, there are examples of these banks. There's one in Pakistan, God, the name just slipping my mind, which is the fastest growing digital bank in the world apparently. And they are dealing, it's called the microfinance bank. They're dealing only with this customer base, and they seem to have penetrated this market and attracted a whole bunch of savings that were not coming into the banking system until they started dealing with them. So it is actually, my view is it is possible to build a small finance bank quite profitably. They could be actually very nice franchises. We can have a more detailed discussion on that offline. Any other questions?
Rajiv, I think we'll have to end because we need